Welcome to the channel JAIIB and CAIIB Made Simple. This is our foreign exchange certification course module A unit 1 lecture, and the chapter name, as you can see, is FEDAI rule and rules. So this is a very important topic. It will cover your basics. So let's get started with the fundamental factor. Everything will be explained in the layman term as much easy as possible using example so that you can remember it for the long time. So watch the video till the end. So let's get started with our first point. The first point is, imagine you are playing a game but there are no rules. You are playing a game but there are no rules. It is completely chaos, right? It will be completely chaos. So the forex, that is the foreign exchange market, is like a giant financial game where bank trade currency. So what happened here? So here the bank, they trade what? They trade currencies, right? Bank trade currencies. So this foreign exchange market is like giant financial game where bank trade currency. To keep things fair and smooth, we have something called FEDAI. What is FEDAI? The full form of FEDAI is Foreign Exchange Dealer Association of India. Right? What is the full form? Foreign Exchange Dealer Association of India. Right? So I told you now that forex is like a giant financial game where bank trade currency. To keep things fair, to keep things smooth, this FEDAI was set up. So you can think of this FEDAI as, you can think of them like a referee, right? You can think of them like a referee that set the rule for the bank dealing in forex. So those banks which are dealing in forex, the rule is set by the FEDAI. FEDAI is Foreign Exchange Dealer Association of India. Now have a look at in detail about the FEDAI. So first of all, it was established in 1958. That is even before a smartphone existed. And it is like club for bank. It is like, you can think of this like club for banks that deals in foreign exchange. So club for those banks which deals in foreign exchange, right? Making sure everyone play by the rule. Let me give you one example. Suppose you think like, suppose banks are player in a football match. Suppose banks are player in a football match. So in that case, FEDAI would be like referee plus coach plus rule book writer. So it will be that would be the role of FEDAI. If the bank were player in a football match, FEDAI would be referee, FEDAI would be coach, FEDAI would be rule back in that particular match, all in one. Now the question is, what are the primary responsibility of FEDAI? Have a look at what does FEDAI do? First of all, it is just like it is just like a rule maker. As you can see, it is a rule maker. It is rule maker for forex. It set guidelines, right? It set guidelines for interbank forex transaction. You can see for interbank forex transaction, guidelines is set by forex. What is the meaning of this interbank forex transaction? So when two banks trade currency with each other. So this is bank 1 and this is bank 2 and they are trading currency with each other. This is called interbank forex transaction. And also second point is, it ensure fair play. Right, this FEDAI ensured what? Fair play. What is the meaning of fair play? So that no bank get unfair disadvantage. Right, let me give you one example. Just like a traffic cop. Have you seen traffic cop? You must have seen, right? Traffic cop. So just like traffic cop set a speed limit, right? They set the speed limit. Similarly, FEDAI set rule so that bank don't take reckless risk in forex trading. So the rule so that bank do not take reckless. This word is key. Reckless risk. To avoid the reckless risk taking capability of bank, FEDAI set rule. Second point, it acts like a bridge. It acts like a bridge between RBI and the bank. So you can see here the second point. On one side we have RBI and on the other side we have bank, right? So the bridge work is control is done by whom? FEDAI. So you can see it acts like a bridge between bank, RBI and bank. So you can think of it like it acts like a mediator, right? It acts like a mediator, right, between Reserve Bank of India and the bank. It helps implement RBI forex policy smoothly. So whatever policies is set by RBI, this FEDAI, it help that policy to be implemented smoothly across all the bank. For example, like you might have heard of messenger. Have you heard of the messenger? You might have. So like messenger, right? Messenger between a teacher here is the RBI, and the student who is the bank. So it is like a messenger between the teacher and the student, like RBI and the bank, making sure that everyone understand the rule. So that is the point. So two responsibility I have just told you. The first one is act like a mediator. it developed rules for interbank forex transaction, and it also act like a bridge between whom, between RBI and a bank for forex market reform. I hope it is clear. Now have a look at the self-regulatory rule. So friends, it does not make just rule. FEDAI don't just make just rule. It also monitor bank to ensure they follow them. Yes, monitoring bank. So in one word, if I say, we can say that this is the role and responsibility of monitoring the bank. So they not just set the rule, they also monitor the bank whether they are following the rule or not. That is the point. So it help bank with training. You can see it help bank with training, advice. You can see advice, support, represent, right, and even represent them before RBI. Let me give you one example. Think of it like, parent association in a school, right? Suppose there is a parent association in a school. So they set the guidelines, training the teacher. So that's called exchange rate announcer. Yes, they publish daily and periodic forex rate that the bank use. So on daily basis also, and on periodic basis, right? They publish the forex rate that the bank use. So it ensures transparency, no hidden rate, like a stock market ticker but for a currency exchange rate. Now have a look at the core function of FEDAI. So first of all, it trains the bank. You can see the keyword, they trains the bank, right? So training bankers. So they train the banker like a forex school. Second, approve forex broker. You can see accredit, or we can call it approve. They approve the forex broker. They ensure only trusted player enter the market. They ensure that only trusted player enter the market. That is called approve forex broker. Then they help bank in forex deal. You can see they help bank in forex deal, which means just like a consultant. Consultant. So just like a consultant, they help bank in foreign exchange deal. They represent bank in discussion with RBI and the government. So represent bank. See, who represent bank in the interaction with RBI, government and financial body? FEDAI. This is a very important thing, the important aspect of the core function of FEDAI. So they represent bank in interaction with RBI, government and financial body, and they update the exchange rate daily. On daily basis they update the exchange rate, right? So that everyone get fair pricing. So to ensure fair pricing, what they do, they update the exchange rate on daily basis. So these are the core function. Now have a look at the FEDAI evolving role. So adapting to the global financial trend like a digital currency. If you talk about the evolving role of FEDAI, yes, they are adapting to the global financial trend. This is the keyword. They are adapting to the global financial trend. Let me give you one example. You might have heard of digital currency. Have you heard of it? Digital currency? Yes, of course you have. So they adapt to this digital currency. This is the evolving role, and they improve coordination with RBI as well as, I told you earlier, several times I told you, that is FEDAI act on the behalf of bank, and they strengthen the coordination with RBI and the financial institution. Let me give you one example. Just like how cricket rule evolve, how cricket rule evolve, right? So T20, right? So similarly, first of all, earlier it used to be only test match, then comes one day, then comes T20. Similarly, FEDAI updated rule to match the modern finance. Yes, matching the modern finance is very, very important. Now have a look at the guidelines for bank. So bank can set their own forex transaction charge like their service fee. So this service fee can be set by the bank. Bank have the flexibility to set their charge, like restaurants setting their own prices but following food safety law. So just let me remind you what we have covered in this particular slide. First of all, FEDAI, in simple word I can say that this FEDAI is just like forex rule maker. Who is the forex rule maker? Answer is FEDAI. They set the interbank forex rule, and till when? Since 1958. Right, the FEDAI sets the interbank forex rule between two banks, right? What should be the rate of exchange, right? Everything is set by the FEDAI. Interbank forex rule, right? Next point, they link RBI and bank. I told you, they act like a middleman between the RBI and the bank. They ensure that whatever policies have been framed by the RBI, are they being followed rigorously in the bank? That is what they check. They train bankers, they approve brokers, they announce the exchange rate. I told you they train banker, they approve broker, they announce exchange rate, and they are constantly evolving with the global financial trend. And bank can set forex fee but must follow FEDAI rule. So next time whenever you exchange currency, remember FEDAI work behind the scene to ensure bank play fair, rate stay transparent, and India's forex market run smoothly. So I hope I have given you sufficient information regarding the FEDAI from this particular slide. Now have a look at the second slide. Friends, if you are looking for complete course on foreign exchange certification course, you can enroll in our current foreign exchange certification course program. You can install our app name is JAIIB and CAIIB made simple, or you can WhatsApp me on this particular number. You will get PDF, videos, mock tests, everything that you required for this examination. You can easily clear the examination in a very easily manner. Now, have you ever wondered how bank handle foreign exchange transaction? Have you ever wondered? Tell me. Just like any business, there are rules to keep things fair and to keep things transparent. You know FEDAI, that is Foreign Exchange Dealer Association of India, they set this guideline for bank dealing in forex. So let's break them down. First of all, I told you now that this is about the foreign exchange charges. So what bank can charge you? So bank can set their own fee. Bank set their own fee, right, based on the service cost. So this flexibility have been given to the bank that they can set their own fee based on the service cost. And you know, but this fee, it must be fair. This fee must be fair. No unfair penalty for a small transaction as per RBI. You can think of it like, you know, a restaurant service charges. Some may charge 5%, other 10%, but they can't overcharge you randomly. On random basis, they can't overcharge you. Now, the second point is, you know, display of exchange rate. What is the meaning of it? So basically, you know, no hidden rate. Rate should not be hidden in any way. So bank must show the currency rate. You know, bank must show the currency rate. Right, clearly on the website you can see, and the branches. So both at the website also and branches also, rates should be clearly visible, and the bank must disclose that what is the minimum amount needed to get the displayed rate. What is the minimum transaction amount for the card rate application? Second point, how often rates are updated? That is called frequency and timing. Like a supermarket displaying prices, you should not get to the checkout and find a surprise markup, right? So that is the point. That is called displaying the exchange rate. Now have a look at this. Following the FEDAI code of conduct, which is the rule book, right? Compliance with the FEDAI code of conduct. This is so called the rule book. So bank must follow FEDAI 2017 code of conduct, right? Submit a formal statement of commitment. This is a statement of commitment that must be submitted, like, you know, signing an agreement. So you can think of it like, you know, a driver. Suppose a driver is there who is following the traffic rule. No cutting lane, or in this case, no unfair forex practice. So there is something called code of conduct which bank must follow, and there is a statement of commitment which must be submitted in the required format. If you talk about the business hour, so a standard forex trading hour is 9 a.m. to 5 p.m. right, IST, Monday to Friday. That is a working day, Monday to Friday. Right, this is the standard forex trading hour. But bank can trade beyond this hour with foreign client. Yes, so beyond this hour, bank can trade with domestic and international client. That is called, you know, foreign client. Right. So bank can trade beyond this hour with the foreign client. Weekend or holiday transaction are allowed, but depends on bank policy. Right. So weekend and holiday transaction, it's not like that they are not allowed. They are allowed, but they depends on the bank policy. So, you know, every bank have a different policy. That's why. Now, you know that like a stock market, you can think of like, you know, stock market. So a stock market which is open at fixed time, but some after hour trading is possible. Now have a look at the transaction beyond market hour. That is called, you know, late night forex. That is called late night forex. That is called transaction beyond market hour. So bank must stay within their overnight risk limit. That is called NOOPL. That is called net overnight open position limit. So that is the point, that bank must maintain, right, their NOOP limit. Bank must stay within their overnight risk limit, and this overnight risk limit is called NOOP, net overnight open position. Right, late night trade between EOD, no, end of day, and 9 a.m. they must follow rule, compliance norm. Suppose some kind of transaction is conducting between end of day and 9 a.m. so they must adhere to the compliance norm. And you know, currency trade rollover at midnight IST. You know, this currency trade rollover happen at midnight IST. For example, suppose 24/7 diner. You can order at 2 a.m. but the chef still follow hygiene rule. So if any transaction is done between EOD and 9 a.m. So you must adhere to the compliance norm. That is what it is telling you. Now friends, working day and holiday. So in working, holiday, when forex business stop. So Saturday is no forex business except exceptional case, specific transaction. It is non-working day for forex. And there's something called known holiday. So it is announced 3+ day in advance. So these known holiday, they are announced at least 3 working day in advance, right? And they suppose there is a suddenly declared holiday. So this is called unplanned, like a surprise bank holiday. For example, like your office being closed on weekend unless there is urgent work. So that is the point. So let's recap the point which we have covered in this particular slide. So first thing first, I have told you that bank set forex fee. So tell me, who set the forex fee? It is the bank who set the forex fee. But condition is that it must be fair. This is the first point. Second point, I told you that exchange rate must be visible on the bank website, on the bank branches, and it should be updated regularly. Third point, I told you that bank must follow the FEDAI code of conduct, and I told you that this code of conduct was commenced from 2017, right? FEDAI code of conduct. Then I told you that there is something called trading hour. So this trading hour is between 9 a.m. to 5 p.m. Indian Standard. And then I told you that about late night. Late night trade occur. Yes, late night trade is allowed, but there is something called risk limit. With risk limit, late night trade is allowed. And I told you that Saturday is mostly no forex business. On Saturday, no forex business happen, right? But holiday can be planned or holiday can be sudden. Holiday can be planned or sudden. So these are the points which I have just told you. So these rules ensure that forex transaction stay transparent, fair, and so what is the meaning of holiday? Holiday means when bank pause, right? That is the meaning of holiday. Now friends, the first thing is suddenly declared holiday. So if announced less than 3 days in advance. So the point is, if the holiday is declared on or after day 1, or we can say if it is announced less than 3 days in advance. Suppose some holiday is announced less than 3 days in advance. So or we can say after day 1 for day 4, right? So this is called suddenly declared holiday. And the second kind of holiday is called known holiday, which means if announced early, like a pre-planned national holiday like 15th August, right? 26th January, like that. So for example, imagine your birthday is on Friday. So what will be the known holiday? The known holiday will be your friend plan a party on Monday, right? Your friend plan a party on Monday. That is the known holiday. And what is the sudden holiday? That they surprise you on Thursday night. So two kinds of holiday are there. Suddenly declared holiday. If suppose some holiday is declared just 3 days less in advance, that is called suddenly declared holiday. And known holiday means if it is pre-planned, that yes, this particular date will be holiday. These are the two kinds of holiday which you must keep in mind: suddenly declared, and the second one is known holiday. Now friends, what is the exchange rate for forex payment? Have a look at it. What is the exchange rate for forex payment? So friends, bank use their current buying rate. Here you can see the keyword bank use their current bill buying rate. Bank use their current buying rate or a pre-agreed rate for export bill. Here the key point is export bill. So remember, for export bill, bank use the current bill buying rate or a pre-agreed rate, right? So this is used for export bill. Now, interest is deducted upfront. Interest is deducted upfront for the delayed payment. So for the delayed payment, what happened? Interest is deducted upfront, and that is called usance period. That is called usance period. Right. So what I am telling you that we are talking about exchange rate for export payment. So bank use their current buying rate or a pre-agreed rate for export bill. I told you early, for export bill always buying rate will be used. This thing you must keep in mind. Either they use the bill buying rate or they use the pre-agreed rate. And interest is deducted upfront for delayed payment. Suppose some payment happened delayed, some payment got delayed. Obviously interest has to be paid. So how interest is deducted? It is deducted upfront, right? and that delayed payment is called usance period. So let me give you one example to make this concept more clear. Suppose you are selling a bike, right? So you agree on either today market price or a fixed price decided earlier. That is the point. That is called pre-agreed rate, means the rate which we have agreed earlier, or the current bill buying rate. Now the question is, what if the buyer does not pay? Suppose the buyer does not pay, what will happen? So that is called, crystallization rule. So crystallization rule comes into picture if the buyer does not pay on the time. Have a look at, okay, what are the rules here? So bank must have a clear policy for unpaid. You can see unpaid foreign exchange bill. Suppose some bill are unpaid. So bank have a clear policy. What is the policy? Suppose the payment is late, or we can say late payment is there. So suppose late payment is there, the foreign currency debt convert to rupee using the bank TT selling rate. So here the key point, if the payment is not received on time, the liability is converted using the TT selling rate. This is the key point, right? So foreign currency debt, the foreign currency debt convert to rupees using the TT selling rate, right? This is the key point. You must keep into mind what happened during crystallization, late payment. So if the buyer does not pay on the time, then crystallization concept comes into picture. That means we have to convert the foreign currency liability into rupee liability. So the foreign currency debt convert into rupee, but at which rate? This question is asked. At the TT selling rate. See, earlier what I told you, that for export bill buying rate is used. But here what we are observing, that when we are converting this foreign currency liability into rupee, we are using the TT selling rate. And what the borrower of rupee value, right? So the borrower of the rupee value, here the key point is, first of all, the borrower of the rupee value plus interest plus charges. So three things you can see. The recoverable amount include the rupee value plus interest plus the charges, right? And one more thing I want to tell you, that interest keep adding until full payment, right? You can see interest is levied from the crystallization date. So like like a library fine. Have you ever paid the library fine? Let me give you one example to make it more clear. Like a library fine, if you don't return a book on time, you owe the book value plus daily fine until you pay. That is the point here. The recoverable amount include the crystallized rupee value. So that is what, that the principal amount plus interest on that plus applicable charges. All of these are recoverable amount. Like library fine, if you don't return the book, you owe the book value plus also daily fine until you pay. Now there is something called a special consideration for export bill. What is the meaning of this special consideration for export bill? Let us clear. See, country with payment issue, that is called externalization issue. What is the meaning of externalization issue? So we can say country with payment issue. Even if the buyer pays in local currency, the bank follow it on forex rule. Suppose the buyer pay in local currency, but the bank follow it on forex rule. For example, like accepting a check from a friend, right? Suppose there is a friend of yours, right? And from that friend, what you are doing, you are accepting a check, right? So who broke? You still follow your bank rule, because that your friend you broke down, right? You still follow the bank rule. So that is called country with externalization issue. Even if the buyer pay in local currency, the bank follow it on forex rule. That is called AD's internal policy on forex rule. That is what authorized dealer have to follow, irrespective of the local currency payment advice. Then payment after crystallization. Try to understand. Suppose the payment arrive after, suppose you have converted the foreign currency liabilities into rupee, and that is what we call crystallization. Suppose the entire crystallization process has happened, and now after the crystallization process, your payment arrive. When your payment arrive after the crystallization process, your payment arrive. So it is adjusted at the TT buying rate. It is adjusted at the TT buying rate or a pre-agreed rate. For example, let me give you one example. Suppose you are selling a phone online. Right? If the buyer pays late, you adjust the refund based on current market value. That is what you do. See, earlier at the time of crystallization, what rate we were using? We were using the TT selling rate. Now, what rate we are using? We are using the TT buying rate. So that too after crystallization. If the payment arrive after conversion to rupee, it is adjusted at the TT buying rate. right? So now let's recap the key point which we have just covered. So let's recapitulate the key points. First thing first, what we have talked about is about the sudden holiday. We have talked about the sudden holiday. What I told you about sudden holiday? So it is less than 3 days notice, right? Sudden holiday means less than 3-day notice. Then we talked about the known holiday. What is the meaning of known holiday? I told you known holiday means it is announced earlier. So known holiday is always announced earlier. Then we talked about export bill. What we talk about export bill? I told you that export bill use bank rate. Either they use the bank rate or they use the prefixed rate, pre-agreed rate, right? And that too, which bank rate? Buying rate, bill buying rate. I told you na, for export bill we have to use the bill buying rate. Now, so next point I told you that suppose some bill are unpaid. So what happened to the unpaid bill? So unpaid bill, you know, they are converted into rupee. That is called crystallization, and it is done at TT selling rate. I told you that this unpaid bill is converted into rupee at the TT selling rate. Here you can see it is converted into rupee at the TT. Remember, these are the key points which I am just highlighting you, right? So whatever bill are unpaid, they are converted into rupees at the TT selling rate, right? And plus interest you have to pay, plus any charges you have to pay, right? And now one more thing I told you, that interest keep adding, interest keep accumulating until you pay, until full payment. And one more thing I told you, that suppose there is some problematic country, suppose problem countries are there, so in that case, you know, AD bank internal policy will apply. In that case, internal policy have to be applied. And lastly, we talked about the late payment. We talked about the late payment. So late payment is always adjusted at the TT buying rate. Remember, late payment is always adjusted at the TT buying rate. So these are the points which we have just covered: problem country, late payment, unpaid bill, sudden holiday. So you know, these rules protect both exporter and the bank, ensuring fair deal even if payments are delayed. I hope it is crystal clear now. I have covered every aspect of it, and as you know that mostly questions are asked theoretical, so these things will help you understand the clear your basics. Now have a look at the next point. So the next thing we have to understand is interest on overdue export bill. Okay, first of all, dishonored bill. Before that, let's understand the concept of this so-called, you know, dishonored bill. Have a look at it. So till now we have talked about crystallization issues. Now have a look at dishonored bill. So friends, let's clear. So suppose you are exporting good. Suppose payment don't all, you know. Suppose you are exporting the good. Payment don't always go as planned. Sometime what happen? Your buyer, they will pay late, right? Your buyer will pay late. Sometime what happen? Sometime they pay early. So bank have rule for both the scenario. Either they are paying early or they are paying late. So dishonored bill. What is the meaning of dishonored bill? So whenever I say the word dishonored, it simply means buyer don't pay. Buyer don't pay. Buyer ने समय पे payment नहीं किया, right? Now the first case is before crystallization. That means you have not yet crystallized to rupees. You know what is the meaning of crystallization? Whenever you see the word crystallization, it simply means you are converting the foreign currency liabilities into Indian rupees. That is called crystallization, right? So before converting to rupee, that is called crystallization. What happened? That bank recover money at TT selling rate, plus foreign currency charges are also included. So recovery is done at the TT selling rate plus foreign currency charges. And you know, extra interest, extra rupee charge, they may also apply. Let me give you one example. Suppose you are selling one car on EMI. Suppose you are selling one car on EMI. Suppose if the buyer stops paying. If the buyer stops paying, what happen? The bank take back the car value, that is called TT selling rate. The bank take back the car value, plus some late fee also apply, plus penalties also apply. You know it, penalties also apply. So that is what I am telling you. Suppose you are selling a car on EMI, and if the buyer stop paying, then bank take back the car value, right? That is TT selling rate plus late fee plus penalty. They have also, this is just an example I am giving you for understanding this concept, right? To understand this concept, this is just an example I am giving you, right? So friends, I hope it is clear now that before conversion to rupees, that is called crystallization, bank recover money because buyer is not paying, right? So bank recover money at TT ceiling rate plus foreign currency charges will apply. Now the second case is interest on late fee payment. Yes, that is called overdue export bill. What is the meaning of this interest on late fee payment? So overdue payment means late export payment. In simple word we can say overdue, late export payment for export is not done on time, it is done late. So what happened in that case? Have a look. So the first thing first, suppose we have demand bill. What is the meaning of demand bill? Demand bill means payable immediately. You know what is the meaning of demand bill? Some types of bill are payable immediately. That is called demand bill. They are payable immediately. So what happened to the case of demand bill? That interest start after normal transit period. Interest start after the normal transit period, that is called NTP. Interest start after the normal transit period. Now what about the usance bill? So usance bill, payment after set period. Right. So two cases we are talking about. Demand bill means which means payable immediately. So interest start after the NTP, normal transit period, and for the case of usance bill, what happened? Payment after set period. So in the case of usance bill, what happened? Payment after set period, and interest start from due date. You can see when interest will apply, from the due date interest will apply. Even if the buyer delay, interest will start after the due date. I think you know the meaning difference between demand bill and usance bill. Demand bill means what? Payable immediately. Usance bill means what? Payment after a certain period. So for these two different cases, when interest will apply, that differ. For the demand bill, interest apply after the NTP, and for the usance bill, interest start from the due date, right? If the buyer delay. So these are the 2 points which you must keep in mind. So for example, let me give you one example. For example, credit card. Take the case of credit card. So like a credit card bill, if you pay on time, right? If you pay on time, suppose this is a credit card. If you pay on time, then no interest you have to pay because you have done payment on time. But if you pay late, suppose you pay late, what happened? Then interest piles up from the due date. That is the point. So demand bill is like you are paying on time. So interest apply after the normal transit period, and usance bill you are paying late. So interest apply from the notional or actual due date. That is the point. Now what about the early payment? Suppose somebody have paid early, what happened in that case? So it is just like happy surprise, isn't it? It is just like happy surprise. What happened in that case? Let's see. If the buyer pays before due date, right? If the buyer pay before the due date, if the buyer pay before the due date, what happened in that case? That bank refund interest for the remaining period. Here you can see bank must refund interest for the remaining period. If the buyer pay before due date, bank must refund interest for the remaining period. And now what happened for the forward contract? Right, for a forward contract, bank adjust notional swap cost, right? And for swap deal, bank settle interest based on fund movement, that is called inflow or outlay. So 3 things I've told you. The first thing is early payment, right? Early payment, which means if the buyer pay before due date, that is called early payment. Bank refund interest for the remaining period. So you can see if the export bill is settled before maturity, so for the remaining period bank will refund the interest. First point. Second point, suppose it is a forward contract, so bank adjusts notional swap cost. And third case is for swap deal, bank settle interest based on fund movement. Let me give you one example to make this concept more clear. So suppose like you are prepaying a loan, like suppose you have taken a home loan and you are prepaying it. What will happen? So bank will reduce interest since you paid early. That is what is happening now. They are refunding the interest. Why? Because they have received the earlier payment. Second thing, if it is a forward contract, like suppose it's a kind of contract which has to be settled on a particular date, that is called forward contract, right? So notional swap cost should be adjusted accordingly. And for swaps, banks should recover or pay interest based on fund inflow and outflow. That is the point. Now friends, have a look at NTP, normal transit period. What is that? See, this is not shipping time. Remember, it is not shipping time, right? It is the average time. You can see the keyword average time. It is the average time for export bill processing. Here is the key point. It is the average time for export bill processing. Average time for export bill processing, which means payment receipt. And different NTP apply based on export type. So here is the key point. Different NTP apply based on the export type. Let me give you one example. So here you can see the average time taken for purchase, negotiation, discounting of an export bill till the realization. That is called NTP. How much time it takes from purchase, negotiation till discounting to the realization of the proceed. It is called NTP. And NTP is not it does not refer to the physical arrival of the good, right? And one more thing, different types of NTP apply. You can see a specific NTP apply to different export category. Now let me give you one example. You might have seen about pizza delivery, right? So like pizza delivery time. Pizza delivery time. Not when it is baked, but when it is paid for it delivered, right? So pizza delivery time is when it is paid for and delivered. That is the point, right? Similarly, NTP is the average time it takes for purchase, negotiate, discounting till the realization of the proceed. And different NTP period apply for different export category. Now have a look at the fixed due date and special cases. So friends, if we talk about the usance bill, whenever I say the usance bill, it simply means that payment will not be sent immediately. It will be sent on the due date, right, by the importer. Now usance bill, they in the case of usance bill, due date are fixed. Suppose due dates are fixed. In that case, what happen? NTP does not apply because payment date is already set. Since the due date is already determined, no need of NTP. But suppose it is a side bill, it is a DP bill, right? Because that on a certain date, that is the due date, I will receive the payment. No point of NTP apply there in the case of usance bill. However, in the case of side bill or DP bill, what is the meaning of DP? So there is something called document against acceptance, that is called DA, and there is something called documents against proceeding, that is called DP. Documents against payment, that is called DP. So in this case, what happened? DP bill, whenever I say side bill or DP bill, it simply means that immediate payment, right? So one side delivery, one side payment. So in that case, suppose it is a foreign currency bill, then 25-day NTP period is there. And suppose it is a rupee bill, then 20-day NTP period is there. So for usance bill, remember, there is nothing such called NTP. However, for the case of side bill, 25-day NTP for foreign currency bill and 20-day NTP for the rupee bill. Remember it. Like a school project. School have fixed deadline, that is called usance, right? School have fixed deadline, that is called usance. Other have usual completion time. So let's summarize the point which we have covered in this particular slide. Let's summarize it quickly. First of all, what we talked about is the dishonored bill. Let me summarize. Dishonored bill. So what is the meaning of dishonored bill? So bank recover at TT selling rate. Bank recover at TT selling rate plus charges will apply. That is called, that is the case of dishonored bill. Remember it? TT selling rate plus charges will apply. What about the late payment? I told you now. What about the late payment? So in the case of late payment, interest will start as per the RBI rule. So dishonoring of the case, TT selling rate will apply plus charges will apply. If late payment is there, interest will start as per the RBI rule. What about the early payment? Suppose early payment happen, in that case bank refund. Refunding is done by the bank. Bank refund the interest, the unused interest. And then we talk about the NTP, which is the payment processing time. What is NTP? NTP simply means payment processing time. Remember, it is not shipping time. Remember, shipping time is separate thing. Most of the time what happen? Candidate confuse it at shipping time. No, it is not shipping time. NTP is not a shipping time. Rather, it is a payment processing time. And now, what about the fixed due date case? I told you now. Suppose we have fixed due date. So remember, if the due date is fixed, like in the case of usance bill, so no NTP will apply there. And if it is a side bill, or DP bill, in that case, what happened? 25 days NTP if it is a foreign currency bill, and 20-day NTP it is a rupee bill. Remember. So these are the points which we have just covered in the previous slide and have just provided you snapshot of the same. Friend, if you are looking for such kind of content where concept is explained in very lucid manner, you can enroll in our course For more detail, you can WhatsApp me on this particular number, right? I will provide you the detail how to access the course, because the entire content have been explained in the simplest form. Every important point have been highlighted. They have been revised several times so that you have to understand it. Now, have a look at the next point. So friends, what we get to know, whether payment come late or payment come early, these rule keep export fair for everyone. So I hope it is clear now. Now have a look at the bank discretion on transit period. So friends, you know that you are exporting goods. For exporting goods, bank have flexible rule for payment timeline, especially when dealing with different countries or different payment method. So let's break it down. First of all, bank can adjust transit period. That is called, NTP flexibility. NTP flexibility. So what does it mean? Bank may shorten or bank may extend the normal transit period, right? So bank can adjust the transit period. Bank can either shorten or bank can either extend NTP based on what? Based on buyer payment history. So which means whether the buyer is reliable or risky. So that is called buyer profile, or supply destination, which we call shipping destination, which means nearby country or far. This is called supply destination. Or transport mode. Transport mode means air, sea or land. So what I am telling you, that bank can shorten or extend the normal transit period based on three things. Buyer profile, which means buyer payment history, which means either it is reliable or it is risky. Second point is shipping destination, whether it is nearby country or far. And the third point is transport mode, whether it is air, sea or land. So one more thing is that must document reason. Suppose any deviation, if it is deviating from a standard NTP, if it is deviating from a standard NTP, you have to document the reason. Any deviation from a standard NTP must be documented, right? And transport mode, whether it is air, whether it is sea, whether it is land, right? So this is called transport mode. So basically what I told you, that bank can extend or decrease the NTP based on few factors. Question may be asked, what are the factors based on which NTP can be adjusted? The first factor is buyer payment history. You can see the buyer profile, means whether it is reliable or risky. Second thing is supplying destination, which means shipping destination, whether it is nearby country or it is far country. And the third thing is transport mode, whether it is air, sea or land. And you have to document the reason. If deviating from the, so a standard NTP is 25 days. And if you are deviating from the 25 days, you have to document the reason. You have to tell me why you are deviating, right? Any kind of deviation from the standard NTP must be documented. And one more thing I want to tell you, that the maximum permissible finance period, that is called post shipment finance period, is 90 days. Remember, I have highlighted it. This is the key point. Maximum post shipment finance period is 90 days and 120 days is allowed for the UN listed country, right? That is the difference. Try to understand. 90 day is the post shipment finance period for most of the cases, as you can see here, but 120 days is there for UN listed country. So let me give you one example to make it more clear. Like pizza. Suppose you are ordering a pizza, right? So pizza is delivery estimate. So suppose you are a regular customer. Suppose you are a regular customer. So obviously, since you are a regular customer, so faster delivery will be there. And if you are at a remote location, so extra time will be allowed. That is what is happening here. So that is how NTP can be adjusted depending on the three factors, like buyer profile, supply destination, transport mode, and any deviation must be documented. I hope it is clear. Now have a look at the rupee bill under letter of credit reimbursement timeline. So if it is reimbursement in the same city, then 3 days. If it is different Indian cities, then 7 days. If it is a foreign bank reimbursement, then 20 days. If it is export to Russia, it is 20 days. So 3/7/2020. Like ordering food. Like suppose you are ordering food, right? So if it is the same restaurant branch, then it is a quick delivery. If it is the same restaurant branch, it is a quick delivery. And if it is a different city, suppose it is a different